you how to get more and better results both personally and professionally. I'm your host, Jean Oursler, also known as the Queen of Results. Today, we have Dick Conroy, who is the owner of and an investment banker of Beechwood Capital Advisors. Say hi, Dick.
Hi, Jean. How are you?
Fine. How are you? And today,
Good.
we're going to talk about raising capital. So, Dick, before we jump into how to raise capital for your business, just give a little background about you and how you got to Beechwood and why you started and what your philosophy is.
My background is I spent about 20 years on the debt side with various banks, Citibank, Dresdner Kleinwer Wasserstein, as well as Fortis Capital, both working in the capital markets as well as lending. Beechwood Capital Advisors was started as the Rockland Group back in 2003, and since then we've been doing a combination of capital raising and M&A. We are a two-person firm, and we're adding roughly 5 people over the next 90 days.
Wow, that's great. So you're growing rapidly, which is awesome.
We're growing rapidly, absolutely.
So then, as a rapidly growing company, sometimes you need to have capital, correct?
No question about it, yes.
Then how do I know, I mean, I know maybe rapid growth might be a way, but how do I know I need to raise capital if I'm a business owner?
Well, let me give a couple of examples. For example, we're talking to a healthcare company, and they've got healthcare facilities in the Midwest and the Far West. They are looking for an additional $25 million. Their choice is to, the reason they're raising the $25 million is they want to buy and build out additional facilities, and they've got opportunities to both buy and build de novo. Their choice is they want to stay independent, and if they can raise the capital, that would allow them to stay independent. Otherwise, what they would have to do is sell to 1 or 2 private equity groups who have put offers on the table, which would mean that the owner would probably retire as opposed to continue in the business. Therefore, what we've said is, look, you're better off raising capital if you want to continue to do this. And this person is on a mission. He's used these healthcare facilities before himself and wants to build this out and make us available for more people.
So then, how will I know when I'm supposed to be raising capital?
You know, because for example, if a lot of businesses, when they went through 2007, 8, and 9, were distressed, revenue was much lower than it was before 2007, and they need to bring the business back. And the best way of doing that is to raise capital to be able to rebuild your business. And in many cases, if they've been through a tough time, that the core capital is lower than what they need to grow the business. The other reasons for raising capital are you want to acquire somebody, or, for example, a company we're working with today, which is in electronic manufacturing. We're raising $1 million for them because their business has gone from $10 million to $15 million, and they need additional capital to be able to finance receivables and finance the growth. So
then you can raise any amount of capital you want?
Actually, larger pieces are easier to raise than smaller pieces. If you came to me and said, look, I need to raise $300,000 for my business, that's a tough amount to raise. If you said I need to raise $25 million, that's much easier because investors have to do as much work for $300,000 as they do for $25 million. So they're in the business of putting out capital, and they'd rather go for the larger amount.
Okay, but I'm an entrepreneur or I'm a business owner, and I'm scared to put, like it's always been my business. It's always been my money. Why would I want somebody else to come in? What's the pitfalls? I don't really want to give a piece of my business away. I'm scared.
Great, absolutely a great point. And it's the conundrum of dealing with, do I want to give a piece of my business away because I need the capital to grow. So maybe I give 5%, maybe it's 25, maybe it's 50%. And what you really have to look at is, number one, is that going to make me a lot more money? And can I deal with the investors on a regular basis? And what we always mention to people is sometimes it's just much better to own 10% of a $100 million company than 100% of a $5 million company.
So, all right, we're going to keep exploring this, Dick, because I'm a business owner, and I think to myself, I don't want to raise capital. But when will I know that I need to raise capital? Can I just go get a loan?
You would want to raise capital on the day that you say, look, you know what? I've got a great franchise here, and I can train other people to work in this franchise with me. Or, for example, if I blow this out over the country and I hire or bring in consultants in Indianapolis and Louisville, Kentucky, and places where I don't have much competition, I can really grow this business and effectively sell it someday to a larger consulting firm. To bring those people in, you may have to bring them in before you have the revenues to support them. And that's why bringing in some capital in advance of that will allow you to keep these people on board. For example, we had spoken to an IT company who basically ran into that themselves, where what they had to do was they have to onboard W-2 computer software people prior to putting them out in the field to do contract work for Microsoft and other major players. And it takes about 6 months to train these people. So they were looking for $5 to $7 million in capital to onboard these people, pay for them until they can put them out in the field and have them productive. So going back to your example, you may want to do that as well if you're looking to expand your business.
So it's better to raise capital than to get a loan?
I'm sorry?
Is it better to raise capital or get a loan?
It's always better to get a loan, but many people can't get a substantial loan. I was talking to somebody today who's in the IT business, who is kind of looking at his business. He's got about 14 people, and probably makes, on the average, $3.5 million a year in revenues, and his EBITDA is about 12% of that. That's kind of normal for the industry. And one of the things we talked about is what is the best way for him to grow his business. And what I had suggested is one of the best ways for him to grow his business is go out and team up with other IT companies of the same size, so that he could build himself into a $40 million company, and you may end up with 2 or 3 co-owners. But at the end of the day, what you're going to end up with is a $15 million business with over $1 million in EBITDA. And at that point, you can go to private equity and say, look, I'm a $15 million business. I want to get to 30 or 40 million. Will you support the growth by making investments so we can buy other people instead of doing these joint venture agreements?
Do you think that men are better at investment capital than women?
Sorry, do I what?
Do you think that men are better at investment capital than women?
No.
No,
they're exactly the same. In fact, I believe women are not as emotionally tied to their business as men often are, because they have other things in their life. They've got children, they've got other things that they're interested in. And us guys are kind of boring and one-dimensional often. So, so what happens, I think women can make more objective decisions about their business and what they really want to do. If they raise capital, they're looking to grow the business. And often what it is because I want to grow my business so I can get out in 5 years. For men, it's often egocentric. I want to sell my business. I want to build my business because, if I build it from 30 to 50, I'm worth a lot more money, and that sells really well at the country club.
So then raising capital is really not a scary thing.
Not in the least. Not in the least at all.
And why do so many people not want to do it?
Because basically, whether you borrow from the bank or you borrow from investors, you have an obligation to those investors, and they have a right to tell you, to the extent of their ownership in the company, what they want you to do. So it's scary because if things are going the wrong way, you're going to get a lot of advice and input from both your banker as well as your investor. So, but at the same time, that's the downside. The upside is they will often support you through the difficult period of time because they've invested or lent you money.
Do you think that most business owners, though, think about investment capital when things are going bad versus when they're going really well?
I think they think about it at both times because we're getting more requests now for capital than we have during the last 7 or 8 years. And the last 7 or 8 years were, I would say, a more difficult economic environment than we seem to be going into now. So the purposes were different. They were often raising capital over the last 8 years to support the company when things weren't going well, but looking for growth equity capital because they see an opportunity to now start growing their sales again, and that requires additional working capital.
So then, if I'm a business owner, is it better to have a product-based business to grow, to get capital, or to have a service business, or does it matter?
I don't think it really matters. As I said earlier, we're talking to a service business doing IT support, including help desk. Private equity funds are just as willing to put capital into that as they are a consumer product business. However, I will say the services business are often higher margins. And one of the things private equity looks for is higher margin businesses which can be grown. And often service businesses can be grown faster than consumer products or B2B businesses.
What do you mean by higher markets?
Higher margins.
Higher margins. Oh, okay. So
margins. For example, we work with a company up in the Northeast, which was a consumer product company, and their margins are running probably 35% gross margins, which means sales less direct expenses, but not including your overhead. A service business could be 60-70% gross margins. So the margins could be much higher, and particularly if for example, the IT firm we talked to, the average customer has been with them 14 years. So it looks like very much an annuity business, which is the kind of business that attracts capital because you have sticky customers.
Okay, so if I decide to do this investment capital thing, what's my obligation to my investors?
Your obligation to your investors is to do what you tell them you're going to do. For example, most people give investors projections. I'm going to do 10 million this year, 12 million next year, and 14 million in 3 years. They're going to base their investment returns based on your projections. If you don't meet those projections, they're going to be rather unhappy because they probably borrowed from banks or put money in your business, and they're not going to get the expected return. So they're going to have a very heartfelt conversation with you in terms of how come you're not making your numbers and what kind of help do you need.
If I'm not making my numbers, what happens to my investors? Like take over my business, or what happens?
What happens a lot, if you sell, let's say, over 51% of your business and they control the business, they can fire you.
Oh.
So there's always that risk. If you have a partner who basically owns more than 51%, but you have the same issue with your lenders, whether it's a sub-debt lender or a bank. If you're not doing well, the bank's going to come back and say, look, I'm unhappy with what's going on. I'd like my money paid back.
All right.
If you're not able to do it, then they're going to have a lot to say about how you conduct business, and they may even bring in somebody to run it for you.
If I know I need capital, and you said it's better to get a loan, and I can't get a loan, then that's when I decide to do investment capital raising?
I would answer it differently. Most companies have a certain debt capacity. And that debt capacity is usually, let's say, 3 times EBITDA. So what happens is that if you need more money beyond your debt capacity, then you need equity or subordinated debt. And again, debt capacity goes to subordinated debt as well. So let's say you've got 3 times bank debt, 1 times subordinated debt, or 4 times EBITDA total. Any additional money you need has to come from equity then. But you always want the least dilutive capital, meaning you want to give up as little equity as possible. So you start with bank debt, then the second tier would be subordinated debt, which only requires often you giving up a little bit of your equity. And then the last part would be going out and getting equity, which would be giving up a proportionate share of the company based on the amount of equity that's coming in.
Is there any timing? Sorry, is there any timing that we should?
That's absolutely a great question, because the timing is as follows, that it often takes 4 to 6 months to raise capital,
Really?
meaning debt or equity. So you want to start the process well in advance of when you need the money. If you're just raising bank debt or asset-based, you can generally get it done in 3 to 4 months. But still, all this takes time. It's expensive. And you want to do it well before you need the money. Probably the worst call I get is when somebody calls up and goes, look, I need $10 million from my business and I need it in 3 weeks. That just doesn't work, because an investor who can put it in 3 weeks is going to demand either a very high interest rate or a very large part of the equity to compensate them for the risk. But if you give him 3-4 months to do due diligence and put proper documentation in place, you're going to get a much better deal.
So then what's the process?
Process is, best process for most people, particularly if it's sub-debt or equity, is hire an investment banker, have them prepare appropriate investment banking materials, which is a profile anywhere between 30 and 70 pages, which explains in detail what your business is about, projections, and basically why you need the money. You'd also put up a online data room, because we never want people calling the client. We'd rather give them the information by allowing them into a virtual data room to be able to pull down the information they need and do the analysis. So once the teaser and the NDA goes out, they sign the NDA, we send them the profile, then give them 3-4 weeks to evaluate and come back to us with a preliminary term sheet. Based on the preliminary term sheets, we sit down with our client and say, look, we rank them in the following order. Here's the people you want to have conversations with. So if we've gone out to, let's say, 25 people, then it's probably a good idea to, if you have 7 who've come back and said, yes, we're interested in talking, then what you do is maybe decide 3 of those 7 have credible offers, and those are the folks you want to speak to. Once you've spoken to them, decide who you want to go forward with, sign a letter of intent, and then assume 60 to 90 days to close your equity.
So how do I find
in this case?
like you?
I'm sorry.
How do I find a banker like you?
I think the best way to find an investment banker is to go through your trusted advisors, because it's a big project to raise capital, and you want somebody who's competent. So talk to your financial advisor, talk to a trusted advisor consultant, your accountant, or even your financial advisor, and let them recommend somebody they've worked with before that you that they believe is competent to do this.
Are there times when people don't want to ask these people for a name because they don't want to disclose that they're looking for investment capital?
See, I would say looking for investment capital is not a bad thing to disclose.
Really?
We usually recommend that our clients don't disclose that they're selling their business because that can be used against them. But raising capital is a good message, not only for the market, but also your employees, particularly if you're planning to grow the business, and that will mean more opportunities for employees to move up because you're trying to grow a larger business.
Okay. So then, so when I find someone, what are the kind of questions that I need to ask them to see if they're the right person for me?
Great question. The questions would include, tell me about your background. What do you, what do you think of my business? Will my business attract capital? Am I doing the right things here, which will clear the market with the investors? What will it cost me to raise capital? How much time will it take? Because if somebody tells you it can be done in 3 months, I wouldn't believe them. I would basically take the approach that it will take probably 4 to 6 months, and you want somebody who's honest with you. What I never like to hear is somebody who says, look, I can get you capital in 60 days, and then 180 or 270 days goes by, and you still don't see the money. So be realistic and expect realistic answers to people you're talking to.
All right, so then give me a horror story of someone that didn't work out well, and give me a really good story of someone who did work out well. So I would know how to pick a good person.
Okay. Basically, we were selling an engineering firm, and we brought a buyer to the table who needed help in financing it. So we not only helped them get the senior debt, but we also introduced them to a subordinated debt holder who put in over $1 million of capital into the business. It was a challenging deal, but the deal ultimately got done. In terms of a lot of things that don't get done is when people are unrealistic in terms of the time. For example, the former example, when we'll get a call, I need $2 million for my business and I need it in 3 weeks, that generally, we try and counsel people it's just not going to happen, and they ought to look at other avenues in this case. The other times it really doesn't work is if people are unrealistic in terms of how much they have to give up in terms of equity. For example, we have a lot of people who want equity in their business. Say they want $3 million, and they argue, look, I'll give somebody who's putting in equity a 10% return. That's better than they can get in the bank. Well, if they're putting in equity, they expect an equity return. And that's typically, if it's a private equity firm, they're expecting about a 30% return, which is 2 times their money in 3 years and 3 times their money in 5 years.
So then, expensive to raise capital?
I'm sorry?
Is it expensive to raise capital?
I would say typically smaller pieces of equity would be a 5 to 7% fee. Raising bank debt is usually 1% of the amount of bank debt raised, and subordinated debt is generally about 3% of the money raised. Obviously, if you start going to large numbers, such as $50 to $100 million, those numbers come down in proportion to the size of the raise.
So then, how do I work with you, Dick, if I wanted to have you as my investment banker?
I would say that we would sit down, talk about your business, decide together, am I the best fit for you? And can I do for you what you'd like to do for your business? And then from there, what we often recommend is a market test. What we don't like to say is, look, give us a retainer $10,000 a month, and we'll tell you in 9 months and $90,000 later whether we can raise your capital. That doesn't work for a lot of our clients. So what we'll do is say, look, give us a modest fee. We'll write a relatively short teaser, and we'll go out to 50, 75 people who would potentially be interested in raising you capital. Once we've done that, then we'll collect the information, sit down with you and say, look, here's what the market is saying. You need to decide whether you want to continue talking to those folks that expressed interest, or maybe if we didn't get much interest, maybe you want to drop the whole process.
Can you work anywhere in the country?
Can I what?
Can you work anywhere in the country?
Absolutely. We've worked in California, we've worked in Chicago, we've worked in Michigan, Florida, Texas. So we worked all over the country.
All right. What's the most important thing I need to know about raising capital as a business owner?
Most important thing you need to know is what is the need really for? A lot of times what happens is that people say, gee, my problems can be solved with additional capital, when often there's other issues with the business that capital may or may not solve. So often what we'll look to do is bring in a consultant, somebody like yourself who's done strategic and operational consulting, take a look at the business and try and determine will the money actually solve the problem or do what the client actually wants done with it? Or are there other things that have to be done concurrently? Because the last thing we want to do is raise capital for somebody and it doesn't work out and you've got an unhappy investor and an unhappy business owner.
Got it. So who is your best client?
Who's my what?
Best client.
Who's my best client? I would say a client who has a business that's $10 million and above in revenues, EBITDA above $1 million, knows their business well. We're generally agnostic in terms of the type of industry because all of us have worked in many different industries, but who clearly knows what they want to do and what they want to accomplish with whatever money they have to be raising. And
how do we get in touch with you?
The way you get in touch with me, I can be reached at either rconroy@beechwoodcapitaladvisors.com or call me on 732-770-5036.
And are you happy to talk to people for a free consultation?
Delighted to do it. Absolutely.
Excellent. Dick, is there anything else I didn't ask you about investment capital that you want to tell the audience today?
I think we're in a very low interest rate right now. So if you're looking for bank capital, this is a good time to get it because interest rates will be rising over the next several years. The other thing to think about also is that because of the regulatory environment putting restraints on the bank, it's been very tough for middle market companies to borrow the kind of capital they need. We suspect if the administration and Congress make some changes in the Dodd-Frank bill, that hopefully money from banks will be more readily available.
Are you someone who can help people get a bank loan?
Absolutely. My background is banking. I know how banks work, and we're very good at getting people bank loans.
Really? So how do you do that?
Best way to do it is to package the loan request in such a way that the banker can review it in about 5 minutes, understand what the loan is all about, and can give you a very quick answer whether their bank can do it or not. The other thing is that it's best to pick bankers who have a history of getting loans approved in their banks. And we specialize in having relationships with bankers who have that successful track record.
And I can get it anywhere in the country?
Around the country, absolutely.
So you do both investment raising as well as helping me get a bank loan.
Yes, we do. It's really capital raising we think of as the right-hand side of the balance sheet. It includes equity, subordinated debt, mezzanine debt, as well as bank debt.
That's
So
fascinating.
any loans or obligations we can help you get.
All right, so for those of us who need to raise capital for our business, Dick Conroy is a guy that you can now call and he will help you get to where you need to go with money. Dick, once again, how do people reach you?
Best way to reach me is by email, rconroy@beechwoodcapitaladvisors.com, or call me at 732-770-5036.
Dick, thank you so much for being on the Get Results television show today. You've been a wealth of knowledge.
Thank you very much for having me.
Yeah, I listen, anyone who needs to, reach out to Dick. He will tell you everything you need to know about raising capital. And I look forward to seeing you on our next television show. I'm Jean Oursler, the Results Queen. Thanks so much for watching. Have a fantastic day.